Two people file under the same rules in the same year. One hands over a share of every dollar the moment it is earned. The other has increasing control over when growth in their assets becomes taxable income. Same code, same country, same year. This is the United States federal tax system. It says it taxes income, but what counts as income and when depends on how much you already have. The 6 levels here are net worth, not salary. What you own minus what you owe. At 0 net worth, waiting for your own refund can cost you money. 0 net worth is not 0 income. What you own minus what you owe is nothing or less. You work, call it $22,000 a year. It is taxed before it reaches you. 7.65% out of your pay for Social Security and Medicare, and your employer pays a matching share on top, separately. Income tax barely touches you. The standard deduction covers most of what you earned, so the refund becomes the whole event. The earned income credit alone reaches $8,231 for a family with 3 children, often the biggest payment of their year. But by law, it cannot be sent before the middle of February. Not just the credit, the entire refund, and it does not matter why you need it. Even the taxpayer advocate cannot release it early, so a market grows in the gap. Your preparer offers an advance, a bank loan, with fees taken out of the refund when it lands. It does not make the government pay faster. The delay is written into the law. The loan is the market's answer to it. At $50,000, the tax system already knows almost everything about you. $50,000 of net worth. A car? A small retirement balance? A little equity? You earn $50,000 a year in wages, and your employer reported every dollar of it before you filed. Here is what most people get wrong. You are not in a $50,000 bracket. Brackets apply to what is left after deductions, not to what you earn. Subtract the standard deduction, and you are taxed on about $33,900, which puts your top rate at 12%. That band runs all the way to $50,400 of taxable income. 12, not 22. You also pay 7.65% on the wages themselves from the first dollar with no deduction for it. And what can you do? Take a deduction you never had to prove. Put money into a retirement account. That is the whole list. Nothing to time, nothing to structure, nothing to negotiate. This level is not complicated. It is fixed. At $500,000, software gets replaced by a real accountant. $500,000 of net worth, home equity, retirement accounts, and a taxable investment account. You earn around $180,000. And the first thing a real accountant tells you is what you cannot do. You can defer $24,500 into a workplace plan, capped and small against your income. A traditional IRA deduction is already phased out at this income for a single filer. Covered by a workplace plan, you can harvest losses, sell something down to offset something up, against ordinary income that is capped at $3,000 a year. For a single filer, once modified adjusted gross income passes $200,000, the net investment income tax can add 3.8%. It applies to the lesser of your net investment income or the amount over that threshold. Somebody will tell you to open an LLC and write things off. An LLC is a state registration. It changes your liability, not your deductions. Deductions come from actually running a business. No business, no deduction. But something real has changed. Money now arrives as dividends and gains, not only as wages. And for the first time, part of when it arrives is your decision. At $5 million, tax preparation turns into tax planning. $5 million of net worth, a business interest, property, a real portfolio. You earn perhaps $600,000. Salary, business profit, capital gains. So you hire an attorney, and the conversation stops being about this year's return. Your top federal rate on ordinary income is 37%. Once taxable income passes $640,600, long-term capital gains top out at 20%, And that 20 does not begin until 545,500. Two different ceilings, same person. It depends what the dollar is called. Then come the structures. People say a trust saves tax, which means nothing. Each one does one specific thing. Take a grantor retained annuity trust, for example. You put an asset in, take a fixed annuity back over a set number of years, and growth above a required rate passes on without spending more of your exclusion. Die during the term and most of the benefit is lost, and $5 million is still under the $15 million estate exclusion. So none of this is about tax owed today. It is about growth that has not happened yet. At $50 million, selling becomes optional, but borrowing gets easier. $50 million of net worth, founder stock, funds, property, and taxable income that swings hard from year to year, because the timing of a voluntary sale is increasingly yours to choose. Not all of it is. Dividends, interest, partnership income, and required distributions arrive whether you want them or not. But the large events, you can time, so you stop selling and you borrow against the portfolio instead. Loan proceeds are not income, not through a loophole, because you have to pay it back. It is not tax-free money. It is a debt with interest secured on your assets, and if it were ever forgiven, the forgiven amount generally becomes reportable income. Then somebody says Puerto Rico. It is not a switch you flip. Puerto Rico source income is excluded for a bona fide resident, and that means 3 tests. You must satisfy the federal presence test, often by spending at least 183 days on the island, move your tax home there, and establish a closer connection to Puerto Rico. You have to actually move. And gains built up before you moved are generally not Puerto Rico source income, which is precisely what the tax authorities are auditing. At $500 million, your tax strategy becomes a full-time business, $500 million of net worth. And here it comes apart, because wealth and income are no longer the same subject. A fortune can grow by tens of millions, while reported taxable income is a fraction of that. Appreciation is not income until it is realized. Capital gains generally arise when an appreciated asset is sold or otherwise disposed of. A voluntary sale gives the owner some control over when. Plenty of events are not voluntary. You do not have advisors now. You have staff, a family office, accountants, lawyers, investment people, full-time, on the payroll. That is not a loophole and not a deduction. It is infrastructure, paid for with real money, and you still do not sell. You borrow. Then there is the end of it. When you die, Section 1014 generally resets the basis of qualifying inherited property to its date of death value. Your heir's gain is measured from there, not from what you paid. There are exceptions. Estate tax is separate, with its own $15 million exclusion. Appreciation that remained unrealized and was held until death generally was not taxed to you as capital gain, and for whoever comes next, the measurement generally starts again. So here is the ladder. At 0, the tax system tells you what you owe. At 50,000, software tells you. At 500,000, an accountant explains it. At 5 million, an attorney plans it. At 50 million, a team reshapes it. And at 500 million, the question is no longer just how much your fortune grew. It is when that growth becomes taxable income, and how much control your team has over that moment. Nobody here broke a law. Every one of those structures is in the code, deliberately. One last number. The Government Accountability Office found that audits of the lowest earners, the ones claiming the earned income credit, produced more recommended additional tax per hour of audit time than every income group except the very highest. The tax code is the same for everyone, but how equal can the result be when only one side can afford to control the timing?